Well, all right. Let's go ahead and get started today. Thank you guys for joining us for this fourth session of our How to Raise Funding from Angel Investors. We have 4 modules here for you today, and as always, we will record the session and we'll send you the recording and the slides afterwards later today or tomorrow. And this being our final session, I'll also make the offer to set up a follow-up call with each of you to talk about your opportunity and what help you may need there as well. So with that, let's go ahead and kick off. As always, we have a questions box on the screen, and we'll run through a few slides, and then we'll stop and take questions, and we'll carry on for the next hour in that manner. So with that, let's go ahead and kick off. We've gone through the process of raising angel funding everywhere from getting ready for meeting investors, pitching investors, following up investors, and what we're going to talk about today is the final section of working with investors. And the first session we have is called Getting Ready for Due Diligence. After you pitched an investor and after they've gone through a process of getting to know your deal better, there will come a point in which they will want to, the interested investors are going to want to dig deeper into your deal, and that's what's called due diligence, in which they have to investigate all the aspects of the business in an in-depth manner. And we'll talk about what to expect for due diligence. Entrepreneurs who have never gone through it are often asking me, well, what should I expect? And we'll look at it here as well. So, as an investor, who's seriously interested in investing, they should be researching the deal. What you'll find is that that process called due diligence varies widely from one angel investor to another. Some investors do a very cursory job of due diligence. They'll just ask a few questions and send a few emails, and that will be their due diligence, while others will take substantial time and make substantial requests on your part for due diligence. So it will come in a wide range of forms when you go into due diligence. What you'll find most angel investors doing is focusing on the risk they perceive in your deal. And we'll talk about some of the key areas they go into in this slide. So, for example, they'll look at the management team. A good due diligence process will interview all of the C-level players on your management team. Investors will meet with them, will look at their resumes, they'll verify the resume information. They often call your references. If you put references on there, most of the time they do get called up. And don't be surprised if they run background checks on you and the team. And the background checks could be checking criminal history and other aspects, and so that's something that most investors are doing today as well. Also, they'll start to look at your market demand. In particular, what they're doing is trying to see what kind of marketing operation you have, what kind of lead generation program you have in place, how many leads are coming in. They'll want to see the leads. They'll want to look at the quality of the prospects. They'll want to talk to some of the prospects, and they're trying to verify that the lead or the deal flow that you say you have is what they think it is as well. Also, they'll want to look at the production. If you have a production facility, if you're making a physical product, they'll want to go out and see it in operation. If it's a contract manufacturer overseas, well, they may want to call up or talk to somebody there just to understand, what is there going on in the operation, where is it, who's doing what, how many units are coming out. If you have a software product, then people will want to talk to the developers. They want to talk to someone who represents the development team just to understand what is going on there as well. They often will research the stated competitors. They will go out and look them up on the website. They'll go talk to people they know in the industry to find out what they know about the competitors in order to understand them better as well. And then there'll be the standard due diligence checklists, of which there are many on the web. We'll have them go through and look at things such as liability and litigation aspects. For example, they'll check your entity filing. If you say you have an LLC, they'll want to see the documentation for that, and they'll go check out with the State Department as to if that entity has really been filed. Any patents or other points of intellectual property, they'll want the patent numbers or copyright or trademark references, and they'll go look those up to see if they have been filed in the way you said. any non-disclosure, non-compete agreements you have with employees. In fact, some investors will ask for every contract you have, every agreement you have, and they'll ask you to pull all of that together for their review. And then if there's any outstanding liabilities or legal claims against the company, if there's any debt, if there's anything related to the company on a financial or legal basis, they'll want to see documentation on that. And of course, something comes up that you haven't mentioned before, it can be in for an awkward time. And so you always want to make sure that this stuff is out in advance of any due diligence. If it comes up in the due diligence and you haven't mentioned it, it can be embarrassing in some cases. So you want to make sure that people are notified that something is there. We have a debt, we have a lawsuit, we have whatever, and then when they get down to the detailed documentation, they're not caught by surprise as well. Also, they're going to want to look at your capitalization table, and what this means is this is the list of who owns what in the company. And I've had entrepreneurs tell me they could not show me the capitalization table, and when I asked why, they could not explain that. And I explained that, well, that is a showstopper. If I can't see the capitalization table, and as most investors will tell you, that will be a showstopper. And it's best to already have this calculated out, put together in one place to show who owns what in the company. And if you have current investors, or previous investors, I should say, that most new investors want to go talk to the previous investors. And a question you'll often get from them is, are your previous investors putting more money in on this round? The answer is yes, that's a good sign. The answer is no, well, it's hard to tell from that. But make sure that you have your capitalization table in order and that the numbers have been calculated correctly as well. Let's see. Also, they want to talk to customers. They want to go out there and interview customers who are using your product. They want to make sure that the customers are happy with it. They want to make sure that the price they paid for it was a good one. They want to look at all your financial statements, not just projected, but now they're going to want to look at actuals. And so you will have to have financial statements made up. They don't have to be audited. In most early stage companies do not have audited financials, but they do need to have income statements, balance sheets, cash flow statements, and your tax filings. Anything you've done in the way of income tax or payroll taxes, they'll want to see as well. And the challenge here is not so much showing the investor this stuff, but rather just having it gathered all together in one place is the biggest issue for these. So my recommendation is to prepare for due diligence, start gathering these documents into place right now. And what I've often found is when I go into due diligence in a startup, I rarely can just start the next day on due diligence. I have to wait 2-3 weeks because the entrepreneur, if they haven't done so, is now starting to gather up all of their due diligence docs. For some reason, this information is not spread all over the office. It is spread all over the country. So my recommendation is to take this checklist that we did today and go gather that up and see if you can pull together a customer list, a prospect list, the name and contact details for your production facility, your tax filings, and try and put all that on one place on your desk in a couple of days, and just go through the checklist and see how far you get. And if you can't put it all together very quickly, we'll go ahead and start gathering that information up now and get it into one place. So by the time you have an investor coming to you to raise funding, you already have all this documentation in one place. So let's stop here and ask if there's any questions. So the first one that came up is, just want to be clear, what do you mean by C-level team? A C-level team, I mean, is anybody such as the CEO, the CTO, the CMO, anybody that's a higher level executive. It's rare that an investor will look at background checks on the administration people or on the production people, but anybody that has a CEO, CTO, or C-level designation, that's the core executive team, and that's who the investors are going to focus on in this, because they're the ones who are making these decisions as they go forward. So what other questions do we have out there? Let's see. All right, the first question is, how long does due diligence take? Due diligence can vary quite a bit. I've seen due diligence go for a week, and I've seen it go for 4 months, and everything in between. And someone once said, due diligence continues until the investor writes the check. And that's one thing to consider, is that some investors go through the checklist and they still don't feel comfortable with the due diligence that they've been doing, and they want to continue to ask questions and to meet. And so don't be surprised if due diligence goes beyond the stated checklist. Yes, everyone has a checklist, but that doesn't always guarantee that when you finish the checklist, due diligence is done. And so it varies quite a bit as to how long it takes. On average, I would say most due diligence takes about 4 to 6 weeks. If I have to peg it, most investors are putting about 4 to 6 weeks of time into it until they exhaust questions and they either become comfortable with the deal or they've taken the decision not to invest for some reason as well. The next question is who in the team is responsible for due diligence? Fundamentally, it's the CEO is responsible for the due diligence. The team will contribute to that. You know, if you have a CFO, they have to put in their documentation. Other executives will put in their information, but the CEO is the one that typically answers the questions that come in. And this is a checkpoint in and of itself. How well does the CEO know his own company? How well can he answer the questions that come up? Are there things that he has to go look up as well? And does he have all the documents at his fingertips? Some investors use the due diligence as a way of testing out the capability of the CEO as to how on top of everything is he, how well does he know the numbers and so forth. So don't be surprised if investors are using the due diligence process to test out the team as well as just checking out all of the documents that go into it there as well. If there are any other questions, go ahead and type them in as we go through, and let's just carry on to the next section. The next one is the term sheet, and this section is meant to talk about the terms that go into a deal, especially if you get into an equity investment where valuation must be set and the term sheets must be all signed up. And of course, I am not an attorney, and you should check with your attorney about term sheets and make sure your attorney is with you in this process. But let's look at it from a high-level point of view and make sure that we understand a little bit about what's going on in term sheets. So the first one is what is a term sheet? Well, it's the document that spells out the details of the arrangement of the investment. And to drill down on that a little bit more, it includes who owns what and at what valuation. So how much of the company each investor owns and the founders, and at what price do they pay for it, basically. The other issue is it goes into who controls what, and it shows who makes decisions and how are the decisions made, primarily by the CEO and the board. And do we need a majority? Do we need a supermajority? Can the CEO go sell the company without approval from the board? These are the kind of decisions that are important, and most term sheets spell out the criteria by which a CEO can go do things. Selling the company, taking on debt, taking on new equity. These are usually terms that require votes by the board, either majority or supermajority, for them to do. And then it also talks about what each party is responsible for, who's going to take care of different aspects of the business itself. And so some of the key terms that go into it, oh, by the way, there's about 125 different terms that can go into a term sheet. If you look at the National Venture Capital Association, the NVCA, they have a nice website that has a list of all 125 terms. What we'll talk about today are the more practical aspects of that, and this is where your attorney comes into place, is that your attorney should be prepping you at some level before you go into a due diligence negotiation. I've sat in negotiations on the investor side of the table, and as the investors would bring up certain terms of what they wanted, oftentimes the entrepreneur would lean over and ask his attorney, what does that mean? And it's a good idea to come in educated a little bit about the terms to know what they mean in order to carry on the negotiations and give a more credible presentation to the investors as well. So one of the first key terms that will come up is the valuation. And this sets the value of the company and how much ownership the investor receives. And as we talked about last week, if you're giving equity out, you need to put some value on the company to know how much equity is going to be given for the money that's being brought into the company, and that's called valuation. And that's set forth in the term sheet. The second one is the control rights, and this is where it comes down to what is the voting power on the board and the board representation. Typically a board, and that's a board of directors, not a board of advisors, but a board of directors is typically 5 people, 2 from the company, 2 from the investor side, and 1 independent. And the board has the ability to decide if the company can take on additional debt, additional financing, if the company can be sold or presented to be sold, what compensation should the management team get, and there's many other control rights that go into it. And when you're negotiating a deal, this is where a lot of the detailed terms are focused on, is how does the voting power go, who gets to make what decisions. Next is share and option investing. This represents the stock options that can be given out by the company. When you go through this process, it's often the case that you'll want to set aside some shares for the employees. 10, 15, 20% is often set aside, and that can be very helpful down the way because you can then compensate employees with stock options as opposed to just direct cash payments. Cash can become tight in companies from time to time, and being able to compensate in other ways becomes very valuable. And to put out what the vesting schedule is, how much of those options and shares are going to be earned over days, weeks, months, and years, goes to a long ways toward creating an incentive plan for employees and also for the management team. The last one is liquidation preference, and I bring this up because this comes up quite a bit. And this means investors get paid first from any proceeds from the sale of the company, with the remaining amount divided according to the proposed equity split. So I was once in a negotiation where the investors asked for a 2x liquidation preference, and they were putting in collectively about $500,000. 2x means that the investors would get 2 times their money back, 2 times $500,000 or $1 million at first. So if the company sold for, say, $5 million, the first $1 million would go to the investors, and then whatever split the investors and the founders had after that, if it was 50-50 or 30-70 or what have you, the remaining amount would be divided according to that ratio itself. And liquidation preference comes up a lot with investors, and so it's something you want to think about as well. The next set of terms are what is called drag-along rights. And these are the provisions that require minor shareholders to go along with the major shareholders. As your deal goes forward and you move from family and friends to angels to venture capital to private equity investors, the later stage investors are usually putting in more money and taking a greater ownership of the company. And so what they're doing is they're putting in drag-along rights to make sure that previous investors go along with the terms that the new investor is putting on the table. The next one is what's called pay-to-play provisions, and these require investors to continue investing to maintain their equity position. So if somebody puts in $50,000 in the first round, it's not unusual for people to ask them to put in $100,000 to $200,000 on the next round in order to maintain the ownership that they had in the first place. Investors are on the lookout for these, but it's also a way of making sure that investors are in there for the long haul as opposed to the short haul. The next one is protected provisions, and this means the founders can't do something without the consent of the investors, such as raising a future round of funding or selling the company itself. And then the last one is no-shop clauses. This means the entrepreneur, one thing you'll find in many terms is that, and this is less in the term sheet and more in an agreement that the investors will give you, is that they want to put a freeze on your deal so that you can't show it to any other investor for a period of time, usually 90 to 120 days. And this is give the investors an opportunity to do their due diligence, proceed with negotiations and valuations and so forth, and not have the deal go away. And there's a trade-off as whether the entrepreneur should sign no-shop clauses or not. So it's something that we would have to discuss individually to see if it's a good deal for your business. The next step after this is to contact your attorney to discuss further. As you go into it, you should educate yourself, and yes, there's the website and some of these terms that we talked about that are there, and you should go and look at that and become familiar with that. Many angel groups have their own term sheet, and when you go into a pitch process, they will send you their term sheet, and that's a good place to start. Take that to your lawyer and have them explain what the different terms mean and what the different conditions are, and start to educate yourself on this thing called the term sheet itself. And as I said before, I'm not an attorney, but you should have your attorney with you all the way through this process. So let's stop and look at some questions that came in while we were presenting that last set of information. And the first question is how do you value sweat equity of the founders and reconcile that valuation with the monetary investment terms? Well, first of all, I'll tell you that sweat equity gets valued very little. The entrepreneurs always put a tremendous amount of value behind sweat equity. I've seen entrepreneurs calculate the number of hours, days, weeks, months, and years they spent on their deal, calculate the salary that they had from a previous job or from a similar job, and then they would turn that into a sweat equity valuation that they would bake into the program. And that carries almost no weight with the investors. The investors only value what you put in the form of dollars invested and what has been accomplished with the sweat equity. So if the sweat equity has generated 10 customers, they will value the 10 customers. They will not value the time it took or the effort it took. They only put credence behind the results that came out of it. So dollars in and results available from the first pass is what they will value it at, and they will have very little behind the sweat equity itself. And it's just the way the game is played. They just don't put much into that as well. Next question is, what are some other terms that you normally see in deals? Well, the first one I see a lot is I see the liquidation preference, and I see 1x and 2x liquidation preferences being put into it. And what often happens is that investors don't feel comfortable with the valuation, the pre-money price that you're putting on the deal, or what the entrepreneur is putting on the deal, and so they start to compensate with terms in the term sheet. And that's why there's 125 of them. Is what you do is what the investor does is look at the deal, and then they try to use the term sheets to balance out anything that they feel is a risk in the deal. So if the valuation looks too high, they start to put liquidation preferences in there just to make sure that they get their money back and maybe something of a return, as opposed to taking a risk on it. Like I said before, there's 125 terms, and there's almost a term for every kind of risk that can be available or known, and so that's what they're trying to do with this. Next question has to do with the board. Who makes the decision on the board about the selling the company? Well, it's usually a collective decision by the board, and the board usually you have to have a majority, sometimes a supermajority, in order to make that decision. But these issues will come up to the board. The CEO can't just go off and sell the company. If that's in the term sheet, they must bring it to the board, and then the board looks at that and votes in a collective manner on it. And so one of the things that's always important is who is on the board. How well do they know startups? How well do they know how to manage startups? And as an entrepreneur, what you're always looking for is someone that knows the startup business very well, and they can give guidance through their board position as to how to run the company. A board can be an asset, not just a control tool, and you always want to make sure you get quality people on the board to help you with those decisions. Those are the questions so far. If you have more, by all means, let's put them in and talk about them as we go forward. Let's move on to the next module. It's called Closing the Round. And I see this a lot with entrepreneurs. You'll find after a period of time, say 3 months of working with investors, that you've got several investors interested, and they're all at different stages. For example, you may have what is called hard interest, and that means they're ready to write checks, or they are about to write checks, and they're ready to go. Then you'll have what's called soft interest, and these are guys who will tell you that they're interested, but they're not quite sure, and they're not committed yet, and their interest is in a range. I'm thinking of 25 to 75, and then but they're not ready to write a check yet. And I often get entrepreneurs coming in and they've got 4 or 5 investors, but no one is the lead investor, and no one wants to go first. And as we talked about in previous sessions, we need to find the lead investor. In often cases, we need to incentivize someone to be a lead investor. And a lead investor basically leads the negotiations and sets up the deal. A lead investor ideally is someone that's putting in about 40 hours of time to actually negotiate the terms, perform the due diligence, look at the documents, and then ideally they've got an attorney themselves that's going through the process of writing up the documents. In a standard Series A deal, there's 9 different documents that have to be built and signed and developed, and that's typically costing anywhere from $10,000 to $20,000. And so lead investors, what you'll often find is they're being asked to go and pay legal services of $10,000 to $20,000 to get these documents signed off, and they're not sure if anybody else is going to actually follow with them, which is why you may find it difficult to talk someone into being a lead investor. And typically the lead investor is putting in a good piece of money. They're not just writing a $10K check, they're writing a $100, $125, $150K check to kick it off. And so it's a large investment as well. And so we may have to do things to promote someone to become a lead investor. And it's important to know what value they bring. As I said before, I often get deals where there's 4 or 5 investors who are all standing back waiting for someone else to go first, and no one does, and it can be problematic for the entrepreneur. Because the lead investor paves the way for the other investors. They take additional risk, and they do all this extra work. And so what you may need to do is actually start finding somebody as you're going through the process of dealing with investors. Identify someone early on who's a potential lead investor, and then start talking to them about it sooner rather than later. And you want somebody that's really interested in your deal, and that they may have the potential to write a good-sized check, and then you want to get 3 or 5 potential leads that you want to follow through with the hope that one will come through and actually be a lead investor as well. And like I said before, you'll need to, in many cases, it helps to compensate someone to be the lead investor because they're doing this work. They're paying for this legal work, they're putting in this time, they're taking the risk. And you can do things such as offer them additional equity for the work they do. You can offer them a board seat, and you can offer them stock options, warrants, grants, or what have you in order to compensate them for doing this work as well. And so when you have the right guy, you can instead of just saying, will you lead the deal, you can ask, what would it take for you to lead the deal? I've often seen lead investors come in, and they'll do this work and take this risk and put the money in, say $100,000, and then a follow-on investor will come and write an equal check. And that follow-on investor, when they get the same amount of equity as a lead investor, it really frustrates the lead investor. They put in all that extra work, and they got no extra compensation. People came in after them, got the exact same ownership that they got, and they're really frustrated by that. And so you want to make clear to the lead investor that they're going to get something that the other guys are not going to get, and that often breaks the logjam and carries this thing forward. So if there's no lead, the first thing we need to do is find a lead, and we need to go ahead and you can try another model where you're trying to gather 5 or 6 investors and have them invest all at once without a lead investor. And what you do is create a sense of urgency. And you do this by announcing an initial close. You'll go out to all your investors and say, we're having our first close at the end of this month. On the 30th of this month, we're going to have our first close. Here are the terms, and you come up with a term sheet. And you shop it out to all the investors. And if the investors are all dispersed and distributed and they don't talk to each other, sometimes this works very well because investors are waiting for the documents to come through, and you can create the documents. Here's our term sheet. Here's our list. Here's all the people that are saying they're going to put money in. And then ask people to look at the term sheet and then see if you can use that to catalyze that first round of investment to come in. And with an initial raise done, you go back to the rest of your investors and say, we've got our first $300,000 in. That sometimes breaks the logjam and brings more investors in afterwards. So in summary, the first investor is the hardest one to find. But what you'll find is as investors sign up, the process becomes progressively easier because there's less and less risk in the deal. The fear of being the only one goes away for the investor. The fear that you may not get to the total fund close starts to diminish as you get closer to it, and you'll find that it goes a lot faster. So let's stop and take a few questions here. The first question that came up a few moments ago is, when do board members need to be compensated? Well, basically, I think board members should be compensated when you're asking them to do something of a heavy lift. If board members are simply coming in and once a quarter they're getting a packet of information and they're coming out to a 3-hour meeting once every 3 months, and all they do is say, looks good, keep up the good work, they're not doing a heavy lift, I doubt they need to be compensated. If, on the other hand, the board is coming in and they're doing a job for the company, they're providing extra help, they're helping raise funding, they're helping grow the business, the guidance is expertise you can't get anywhere else, well then you may want to consider compensating for the board at that point. Many startups simply don't have the funds to compensate boards, and so they're looking for people that don't require that. Some companies do have the funds to compensate, and my recommendation is you get people that can really help you grow the business. And if a board member is doing 2 full-time days a month of work, well then they should be getting some compensation for that, for you and the board member to negotiate that out, of course. Let's see, what other questions have come up? Where do you find lead investors? Well, I think the first place you find lead investors is in your existing investors. Even if they haven't led a deal before, you should go with people that are naturally interested in your deal. Now, what you can do to make it easier for the lead investor is go ahead and gather up all the due diligence documents that they may ask for, put it into one place, and make it very easy and accessible for them to get. Bring in a sample term sheet and see if that's of their liking and see if that helps as well. Next question is, what about compensation where some work and others do not? I've done stock options amounting to $8,000 per year. Is that okay? And I think that's okay. I think what you're doing is some board members are going to be available to do extra work, and they should be compensated. Other board members are not available to work or not interested, and so they're not being compensated, and I think that's fine. I think it should be known to everybody who's doing what. I don't think it should be a surprise to anybody, but that compensation, $8,000 a year, sounds reasonable, depending upon what they did for it. I've had work with some investors who charge $100,000 a year for their work on the boards, and I often question how much value they were able to give for $100,000, or did they give enough value for $100,000 is a better way of saying it. So you want to look very carefully at what kind of compensation they're looking for and what they're doing for it in return. Any other questions that we may come up? If you have any, go ahead and type them in. We have one more module to cover here, and it's after the deal is done. It typically takes 4 to 6 weeks to paper a deal. Some lawyers, attorneys move faster than that. Most do not. It takes time to draft the documents. As I said before, there's 9 documents that go into it. There's the term sheet. There's a subscription agreement. There's a stock option plan that's often made a part of the deal. Most good attorneys will ask all of the investors to sign a letter stating that they are an accredited investor. And so it takes a little bit of time to put these documents together. You must physically have investors sign all of these documents, and as we become increasingly virtual in this area, you'll find that investors are increasingly at other areas, other places, and you have to work your way into their schedule to get them to take the documents, print them out, sign them, scan them back in, send them back to you, and they have to write a check and send to you. And oftentimes the checks are placed in escrow with the attorney until all the checks are in and then the funds are released. So there is a little bit of a process that goes into doing the deal. And so once the deal has been papered and signed and all of it's done, most entrepreneurs say, well, we're now done with investors. We don't need them anymore. But my recommendation is that you continue on with them in certain ways. The first thing that needs to come up is what are called information rights. In the term sheet is typically a term that says the investor gets updates about the deal or about the status of the company on a regular basis. And there's often confusion there. The investor thinks, well, it's written to the term sheet that he's going to get information, and the entrepreneur knows he needs to deliver information, but there's never a meeting of the minds as to exactly how are we going to do that, how often and in what form does that take. And my recommendation is that you talk to your investors about what is the best way of doing this and make sure everybody's in agreement before you go forward. But having said that, the entrepreneur does owe regular reports to the investor. And what I found is the frequency and format really depends upon the entrepreneur's needs and the investor's needs. Potential reporting formats that I've been involved with included face-to-face meetings. I've had deals where they just give me quarterly email reports. I've had conference calls where we all get on the phone and we talk about it, and there may be other ways as well. What you'll find is that in the early days of the startup, the communications are often frequent because the investors are trying to understand more about the deal, and they're excited about the deal. And as it becomes more known what is in the deal, as the company becomes more steady state and levels out a little bit and becomes more stable and solid, then you'll find the reports become less frequent or less detailed. But the key here is to gauge the reporting to the needs of the business. I've worked with some companies that are in crisis mode, and we were meeting every day. I've also met some companies that were very stable, solid, everything was on track, all the milestones being met, all the metrics are being met, and I would get an email about 3 paragraphs once every 3 months, and that was sufficient. So you want to look at the status of the business and then report. You'll find that investors have some discomfort early on or anxiety because they want to understand how it goes. So you may want to do more frequent reports in the early days, first 6 months, first 9 months, just to make sure that they're comfortable with the deal. And then as they understand it better and as the company hits a better place, you can make it less frequent. Realize these reports take you time. Oftentimes, and I talk to entrepreneurs, how long does it take to do a report to the investors? They say it takes a half day to a full day to pull all the information together, write it up, make a good package out of it. So it's time that you're spending reporting to the investors that you're not spent working with the customers or the products or what have you, and so there's a trade-off in there as well. So typically in the reports you send out to the investors, you're putting in current financial statements, relative to forecast, and then you're showing what milestones were accomplished, and then you're putting in the plan for the next 12 months. And typically there's a 2-3 paragraph write-up that's describing how you're hitting milestones and how you're a little bit behind and why things are off or what good news is going on in the business, but you're giving a high-level view in a short amount of time about how the business is going. As we said before, you'll want to build a board. As you close out the deal, you'll want to put a board into place. And the board of directors has a fiduciary responsibility. They oversee the CEO. Many people do not take board seats anymore because of the liability involved, and you may want to get involved with what's called D&O, Director and Officers Insurance. This is insurance that if the board is ever sued by anyone, they've got some insurance or protection behind it. For early stage companies, that can be very expensive insurance, but for later stage companies it could be a good idea. But just to know that it's out there is what I'm making clear here. The board reviews operational plans, compensation plans, and other key aspects of the operation, such as approving stock and option grants, selling the company, taking on new investors, making a divestiture. All major decisions typically need to go through the board, and you'll want a team that can really help you. As we said before, a typical board consists of 5 people, 2 from the company, 2 from the investors, and 1 independent. You can have 7, 9, or more people on the board if you think that's necessary, or the investors think it's necessary too. Typically, board members' terms are not set in the term sheet, but most people remain on the board for 2 to 5 years in many cases. I'm a big fan of moving people off the board if they're not of interest to contribute anymore, they don't have time, and trying to fill the board with people that can proactively help you is what I always advocate. Because a well-crafted board can be an asset to a startup by providing additional experience. And it can also give additional credibility to the company. Sometimes you want board members on there not because they're actively helping you, but because they have a name or reputation that really helps your business and what you were trying to do. And then you can also get experienced people on the board who can help you in times of crisis. And almost every company I've ever invested with has gone through a time of crisis. They have either run out of cash, they have been sued, their major customer that comprised 70% of their revenue has gone away. So it's not a matter of if we will hit crisis, but a matter of when we will hit crisis. And to have people on the team that can help you with that, what do we do when we run out of cash, can be very helpful. So you might look at that aspect of it when you're building your board. Board meetings are typically once per quarter. They last 3 to 4 hours, and they're typically held at the company's office. It's a great opportunity for them to come out where the office is, meet new members of the team, get an update on the team. Things are changing over time, and it's a great way to make sure that they're up to date with what's going on. Typically preparing a packet of information with the financials and operations and sales forecasts and so forth will typically take you a full day in order to get ready for it. And you're often putting slides together as well in order to walk people through your board package. So the next question comes up is you've raised your funding, this round is closed, the board is set, and now you're ready to get down to the operational task full time. And someone once asked me, well, when do you stop pursuing funding? And my answer is never. You should always be at some level pursuing funding, although at this point in the game it drops dramatically as to how much time and effort you're spending on it. But entrepreneurs should continue to raise funding until the investor's check clears the bank. I often see that entrepreneurs will get some strong interest from an investor and they immediately drop all fundraising efforts. They don't want to take any more visits. They don't want to do any more pitches because they have an investor, and they basically drop out for 2-3 months because they have an investor, only to find them coming back to me 3, 4, 5 months later saying, well, the investor said no, or it didn't work out, or we couldn't agree upon terms, and they have to restart. So my recommendation for those who are raising funding is you keep pitching and you keep talking to people no matter what interest you get from other investors until their check clears the bank. Even if they're in due diligence and negotiations, you should continue talking to all investors because you never know if that investor is going to make it all the way through the process, and you don't want to lose any time. After the funding round is closed, the check does clear the bank. What most entrepreneurs do is they drop all contact with investors who are not in the round. Those who did not write checks are wiped out off the list, and the entrepreneur never talks to them again. My recommendation is that it's better to keep those investor prospects, those who didn't invest but they know something about your deal, keep them on a list and continue sending them quarterly updates on your progress. Just as you were doing before, you were sending out these monthly updates. Take your board report, sanitize it a little bit, take out the detailed financials or proprietary information, and just put a few high-level details in there and continue sending it to those investor prospects. And the idea is to get them ready for your next round of fundraising. Over 60-70% of the investors, entrepreneurs I should say, that go through our funding forums, they come back and they're looking for another round of funding 18 to 24 months after they close the first one. it is much easier to raise funding from a group of people that have been kept informed of your progress as you go along than it is to try and restart the discussions from scratch. And most of the investors who were interested in the deal but did not write a check were typically more risk averse. They just didn't want to take as much risk. And if you go back to those guys 18 months, 24 months later, there's even less risk on the table because now you have 200 customers, not just 2. Now you've got maybe $2 million in revenue, not just 200. And so it becomes a lot easier to switch them on to investing in your deal because they already understand something about it. And so my recommendation is you keep mailing out updates to those investors as you go forward, because you never know. People often tell me, well, I'm finished fundraising, I'm not going to do anymore. Then they come back later for one of two reasons. One, they have a new opportunity. They didn't foresee it, but now something has popped up and they want to go after it and they need additional funding. And number two is, well, things didn't quite go as planned as we thought. We ran out of money a little bit faster than we thought, and we're going to have to raise more to achieve the goal. And if you have people that are knowledgeable about your deal, those are the ideal candidates to go back. But you have to have kept them informed at some level along the way in order to get that. So let's see what questions we have here. And this is our last module. So after this, if we're finished, we'll wrap up. But let's see what questions show up here. So the first question is about the board. How do you run a board meeting? Okay, well, typically in a board meeting what you're doing is you're passing out a packet of information that has financials and write-ups, and people are reading about it. You may have sent something in advance, but most of the time the board guys are picking it up when they get to your office for the board meeting. You have an update about the team and about sales and about forecast, and then about operations, and then major decisions are put on the table for discussion. You typically go around the board and everybody around the table gives their input or their feedback on it, and then you, if there's a vote, you make a vote on it. And then the next step is you typically have some PowerPoint slides that you're walking through, highlighting the packet of information and making sure everybody understands everything. And then typically you serve a little bit of food afterwards. And so typically that's what you do in a board setting. It can be adjusted or varied based on what you're trying to accomplish in that meeting, but fundamentally you're updating the board and having them make the decisions that they're supposed to be making. So the question is the CEO is always on the board? I've always thought so, but some inputs have challenged me on this. They're not always on the board, but every company I've invested in, they have been on the board. In some cases, the founders are almost always on the board, but the CEO is usually on the board, but not always. And so, like I said before, there's 2 from the company that represent it, and it's often case the CEO is there. The board wants to talk to the CEO, so even if they're not on the board, they're usually required to be a part of the meeting because operational questions are often going back to the CEO itself. The next question has to do with following up investors. Should we continue sending updates to investors even if they told us they're not interested? Well, I think the key is you have to get permission from investors to send them updates. You can't just keep putting them on a list and sending them updates when they told you they're not interested. I always like to use the phrase, may I keep you informed of our progress, because most investors will say yes to that just because they want to hear how the story turns out. They may not be interested in investing, but they're always curious as to, did you raise the money, how much did you raise, what happened to the company afterwards. And you put it in those terms, you'll find permission in order to send them stuff. But in today's permission-based world, you really need to get permission in order to send something out to them. So after you close the funding, you should ask your current prospects, would you like to see how we do? May I keep you on the list and continue sending you updates? And if they say no, well, you take them off at that point. You want to keep them in a separate list for later, but the idea is you don't want to spam them anymore with emails that they're not interested in as well. Are there any other questions at this point? We're almost near the end of our time. We have a few minutes left. If you have any last-minute questions, go ahead and put them in, As I said before, I'll package up the slides and I'll package up the recording today and send that out to everybody. And then if you would like, just reply back to the email and we'll set up a time and talk about your deal or your questions or your specific circumstances and see what we can do to help you out there as well. I don't see any more questions at this point, so we'll go ahead and wrap it up. Thank you guys. You've asked some great questions and been a great audience these past few weeks. I appreciate that. If you need help going forward, please let me know. We're here to help you raise funding. We can put you in front of investors and we can help you, help coach you through the process, and looking forward to working with you on your fundraise. Thank you guys very much. Appreciate your joining, and we'll go and wrap it up from there.